Tyler Crow, lately, I feel like we've done a lot of talking about stocks that are down in the dumps and beat up and cheap, and maybe cheap for a reason and not worth buying, and a few that we think are buy on the dip opportunities. But we're going to do something different, man. This stock is up over the past year. I'm looking at it, the past 52 weeks, it's up 52%. It's up 52%. Here's the thing, it's still basically dirt cheap, buy hand over fist, load up, back up the truck, whatever you want to say. It looks really cheap.
Want to know the other secret? This is normally in an industry we hate.
I'm Jason Hall. This is The Smattering, and our videos are sponsored by The Motley Fool. If you're looking for even more great stock ideas, please check out our special link, fool.com/The Smattering. The Motley Fool's got its 10 best stocks to buy right now for you. Please check that out after this video. Now, Tyler, I'm not kidding here, right? It sounds very like Carnival Barker-ish to be saying some of the things that I was saying. On the screen here, it's up 52%. We're recording this October 4th in the afternoon. So this is as of this moment. But you start taking a closer look at this company and it gets really cheap. I'm going to show the valuation metrics in a minute. But first, what is Stellantis? Why don't you
Well,
hate the industry, but why do you love this particular stock?
okay, so Stellantis is, to those who are less familiar, it is the reborn version of what used to be Fiat Chrysler. Fiat
Right.
Chrysler a few years ago went with a merger with Peugeot Citroën Group in France to create one of the largest automotive manufacturers in the world. It was a huge roll up of a bunch of different, especially in Europe, which I don't think we talk when we talk about autos. So often it just kind of defaults to North American autos, but there is a global auto market out there. Finally, they got their stuff together and started to consolidate. And Stellantis is one of the big
Right.
beneficiaries of that. And
Like
that's
it's the house of brands in the auto industry, but it's been able to consolidate a lot of those brands in terms of manufacturing and the end output and drive really good operating margin and really good
yeah.
results. That's the bottom line.
And for all the things that we have said previously about why autos stink, it's an awful business, it's cyclical, they don't generate returns, and all the other stuff about North America, here are some of the things that I think actually differentiate Stellantis from so many of the other ones in this business. We talk about Ford and GM all the time, and it always comes down to they're profitable building trucks and SUVs in the United States, and that's about it.
Yeah.
Ford credit,
That's a
GM.
broad generalization. They make essentially all of their profits selling trucks and SUVs in North America. And they have other little pockets of places in the world that they make a little bit of money,
Right.
but they have a lot of loss leaders and they suffer from high operating costs. We saw it's still ongoing with the unions, right? They're trying
Yep.
to work through a labor agreement in North America that's a major headwind to affect their profitability even further down the road. Again, let's talk more about what's different with Stellantis.
Stellantis, same thing. That North America issues are the same because they own Jeep, they own Ram, they own Chrysler. They're now considered part of the Detroit Big Three because they owned Chrysler, and so there are the North American components, iconic brands that are very profitable for them. But the differentiating factor is Stellantis is profitable around the world and has considerable market share around the world. And I'm just going to highlight some of this. They have a 15% market share in Middle East and Africa with a 25% operating margin on its sales there. They have a 23% market share in South America with a 15% operating margin. You don't really brag about their market share in China, India, and the Asia Pacific, but it also produces a 15% operating margin on its sales there. This is a business that knows how to sell cars worldwide and not just to the North American consumer. And that is critical because there is an emerging growing middle class, consumer class worldwide. And that is going to drive growth in discretionary products like vehicles. And if somebody can meet them with an offering that's profitable, they're going to do spectacular. Ford and GM haven't figured that out yet. Stellantis knows how to do this. And I think that's a huge differentiating factor if you're looking to invest in kind of the growth of automotive worldwide.
What about
Now,
EVs? I think we need to talk about EVs here for a second because so far this has been one that has been slower to roll out electric vehicles. At least, again, those North American centric brands, we
mhm,
haven't seen the same focus that we've seen from GM and Ford as they fight the Tesla market share taking
yeah.
as it continues to move down market.
Admittedly, they have been slower. They have made progress in certain spaces. One of those spaces that they have made some of the most progress with electric vehicles is actually with commercial vans in Europe. The Fiat commercial van is one of the more ubiquitous kind of like commercial vehicles that you see in Europe, and they have had a lot of push on the electrification there. A lot of the brands that we know in the United States or in North America have not been ones that they've pushed electrification on very hard. It's been a lot more with
The Dodge Hellcat is not targeted at
nope,
the typical EV
nope,
buyer, right? Burning
no.
rubber.
Their electrification efforts are much more with their Fiat brands, with Citroën, with Peugeot, and the places like that, where the consumer in Europe is a little bit a different character. You're probably not going to see a lot of those brands in North America anytime soon. So they're rolling it out there, and they'll probably get to some of the stuff. I know that they're actually rolling out a Dodge Ram pickup truck that's going to
Yep.
be all electric pretty soon. So
Yep.
it's coming.
They've
It's been
also made,
slower.
Tyler, they've also made a push with hybrids and plug-in hybrids
Hmm.
with and EVs. We're seeing more with minivans. They have a couple of different Jeep vehicles as well. With that, we are seeing that start to proliferate where there is more interest as well. And in vehicles where, again, historically they've been able to make pretty good margin. And
Yeah.
minivans has been a profitable area. The Jeep brand has been a pretty profitable area as well. So it seems like they're taking a smart approach to going
Yes.
after the market based on their market dynamics.
And another component of that that I think investors should be well aware of is when we talk about the electrification part or going EV and how much it's going to cost and change the way that we think about these businesses. I want you to, this number, remember this, $57 billion. That's how much cash Stellantis has sitting on its books right now. $57 billion in cash, $32 billion in debt, more than $25 billion in net cash, just ready to be deployed to do these sort of things. And that is an advantageous position that you want to have when you know that you're going to be spending mountains of money to transition your business to something else.
So we have an automaker, it's a global automaker that they have demonstrable profits in essentially all of their key markets. They sell vehicles and they make money in all of their key markets, which is a differentiator from a lot of the larger global automakers, particularly the US based ones. Now, we've talked a little bit about their strategy and how they're starting to deploy more EV powertrains, plug-in powertrains in pockets in different areas. We talked about the balance sheet. We've talked about the fact that it's a cash positive business. We really haven't talked about valuation, right? Which is the key. That's what we led off with here. Is it's just, again, it's a stock that's up over 50% in a year, and it's still, we say, dirt cheap. I'm going to pull up some numbers, and if you can just give us some commentary on what we're talking about. Let's talk about that purple line first.
Yeah, so purple line is the price to book value, which basically means like every single asset that is currently on the company's books, its factories, its inventory, its patents, whatever you want to add to that component, it's basically like everything that it owns. And if it were liquidated today, that's considered book value. Like we can just close up shop, sell everything off, and that's book value of what we have. Right
So you're
now,
buying a dollar for 69 cents is essentially what we're saying here.
basically what we're saying is
Right.
because it trades at for 6.69 times its tangible book, it means that the market says that we don't even want to pay a dollar for a dollar of assets. We want to pay 69 cents. And that doesn't happen very often. I just give an example.
Yeah.
Ford Motor Company, 1.1 times book.
So I
Okay.
think the key here, though, is that we're not, I want to stress this. This is not some, to a certain extent, yeah, this is a deep value, traditional deep value opportunity, but there's a lot more to it because you're not just buying a dollar for 69 cents. You're buying a money printer for 69 cents on the dollar. Because again, this is a profitable cash generative business that's trading for a deeply discounted price, right? So
Yeah.
let's talk about these yellow and blue marks here, which is the earnings multiple. Again, for most automakers, if you were paying 7 or 8 times earnings, trailing or forward, particularly because you think about the cycles, you would be pretty happy to pay that, all else being equal, right? But we're talking about half, less than half of what would be a discounted earnings multiple for most automakers. I want to ask you one question, Tyler. Why is it so deeply discounted? What does the market think is going to happen that it's willing to discount this company so much?
We know for a fact that there there is some sort of expectation that we're going to have some sort of, if not a recession, some sort of economic slowdown, which is going to affect purchase prices. Higher interest rates means that auto loans are considerably higher, and so that's at least the North American market. And so you start to look at that and say, okay, we could definitely see some sales growth, sales stagnation, if you will.
And there's more to it,
I
right? It's not just the stagnation, because when the way these companies make money is by operating leverage. The idea is you want to keep those plants running as efficiently as possible. When global economy weakens, auto sales slow down, they slow down for everybody. Everybody begins to fight harder for market share to keep the gears turning in those factories, which means prices fall, which
yeah,
means that margins get affected even more. So all of those things can have a compounding effect. And the market seems to be predicting that's what's going to happen
yeah.
for Stellantis.
It's seemed to be saying that Stellantis's decline is going to hit harder than Ford, GM, or any of the other, name your automaker, if you
Right.
will.
Toyota,
Um,
Volkswagen, the
I
large.
don't know if that's true or not, but it's certainly pricing it in that way. I think there is a bit of a notion of playing a lot more to the international markets doesn't seem to attract as much investor attention as the North American market does. And so people, I would say, probably myopically look a little too hard at the North American market and don't look at international sales. And because of that, don't necessarily rate Stellantis appropriately based on what it's doing there. And just looking at the carbon copy of Ford and GM saying, well, they don't make it there. I can't imagine Stellantis is doing it either.
So you take all that and put it together, and the market clearly thinks this is a company that's in some sort of trouble or has struggles in its future. But I think any way you look at it, if you take the multiple, the balance sheet, the profitability profile of this company, and you look multiple years down the road, past whatever that happens with the economy in the next year or so, I think investors are going to make money to buy Stellantis stock.